Hi, this is Matthew Cheung from Work in Fintech, and today I'm delighted to be joined by Jonathan Holis, who's a managing partner of Mountside Ventures. He also cut his teeth at PwC, where he helped to found the raise and scale programs that was helping early stage startups. So hi, Jonathan. Thanks for joining us today.
Great to be here.
So we've probably known each other a few years now, probably like 5, 6, 7 years, something like that. And we actually met through PwC when I Push Pull, which I'm also a CEO of, was looking to raise some money. We can kind of go into startups and early stage funding and talk about those interesting factors and things you need to know to make that process more efficient, because that's essentially what you do. But before we jump into that, do you want to just kind of introduce yourself, talk about some of your background, talk about some of the story about kind of how you've got to where you are today?
Sure. So I was born in Brussels, moved to the UK when I was 8. I couldn't speak the language, so that was a bit of a challenge, but got to grips with it in a 5 or 6 year period, and was raised after the age of 8 in the Midlands. So spent my time in Warwick and in Leamington, and then went to uni. My now wife's father requested that I get a professional qualification before marrying his daughter, and so I did. And they recommended the ACA, which is the professional accounting qualification, which I can highly recommend doing. And the idea was it provides a grounding from an educational perspective and a bit of a passport to get into different jobs. And so the idea is you learn the basics of business through an accounting lens. Did that for 3 years, and then that allowed you to, it opened up different opportunities, which is after that what I did, and I explored at PwC a number of different secondments. So I worked in the data team because I got quite worried that all of audit was going to become done by robots. So I thought I'd better start learning a bit of programming, a bit of code with a data lens. And during my time actually in audit, it did turn more into tech. So my first audit, I was counting invoices and checking documents. By the time I'd left, it was all done manually, so it was all done through automation, and the manual work was only the risky items. Anyway, so did that for a bit, did a stint in the data team. Also then got back to, I guess, my interest and passion, which was startups, and so landed in the capital markets team. And within that team, normally IPOs and capital markets is associated with big companies, but I had the opportunity of working with Crowdcube when they raised money on their own platform. So Crowdcube are one of the big crowdfunders, and they decided to raise 5 million plus, and they decided to raise on their own platform, which was quite a neat way of doing it. Worked on that transaction, which reminded me that startups, is where my interests lie. And so I then landed in the innovation team, and at PwC we were tasked by the board to try and build a proposition that appealed to early stage companies. PwC was known for its corporate clients, but it had barely any presence in the startup world. And so I guess we had an objective to make it a bit of, make it well known or better known. And so we did. We built a couple of propositions to service the industry. One of them was leveraging the clients of PwC through a corporate accelerator type model, where companies come, they pitch to maybe a room of PwC executives and also corporates to try and land a deal. And then the other was then turned into a fundraising program, which Matthew was involved with, and that became a way of supporting companies on their fundraising journey. Decided that actually that was what I was interested in, having started the proposition 7 years ago now, and decided 3 years ago to leave, and launched Mountside along with 2 other co-founders who were also involved in that proposition at PwC. And here I am today.
So what does Mountside do?
So we're looking to build Europe's leading advisory firm, specifically focused on fundraising, with a mission of optimizing that process for founders and funds. There's a lot of, if we take a step back and look at the pain points that startups, especially fintechs face, they fall into three categories: access to customers, access to cash, and access to talent. And one of the things that you find working for a professional services firm is that it's much more exciting working with companies where what you're selling is what they want, as opposed to compliance and other regulatory work, like an audit. And so we decided to focus on this fundraising angle because, speaking to founders, fundraising is a big pain point. And so as a result, that's what we're trying to do with Mountside. We're trying to make that fundraising process as efficient as possible for both the founders, but also for those investors investing.
So can you talk through what a funding process is? If I'm starting with a blank sheet of paper, I'm at university at the moment, I might have a great idea. How do I take that great idea to fruition? On the fundraising side rather than the go-to-market business.
I think that's you can talk for hours on that.
Yeah.
On the fundraising side, let's assume that you've got a bit of traction and a bit of revenue, and that you're interested in approaching investors. I guess the first thing to do is to make sure that you've got a good set of documents. You've got a good teaser or a good deck that you can show to people, and there's lots of information on our website. If you go to mountsideVentures.com, that we list all these resources on there. But if you've got a good teaser and a good some good materials, maybe a deck, maybe a business plan, if you're starting a business for the first time, with some key sections such as what market you're going after, what problem you're looking to solve, what is the solution, who are the team, who are the people that you've decided to convince to join you on the journey. It might just be yourself, it might be other co-founders. A bit about how much you're looking to raise, a bit about what kind of numbers you're targeting. So you're looking to grow a big business, you're looking to grow a medium-sized business, or you're looking to grow a lifestyle business. The majority of companies in the UK are lifestyle businesses. Think your local barber, your shop owner, all these businesses generally are maybe family run, or maybe as a sole trader or as an entrepreneur. So there's a certain type of business that you might want to build, within these, either a lifestyle, medium, or a big unicorn type company like a Facebook or an Uber. So you've got your documents in order. You've figured out what kind of business that you're looking to build as a result of that, and then you might start looking at identifying which investors might be relevant for you. And there's different investors that invest at different stages. If you're at the early stage, you might look for some early stage venture capital funds. If you decide that the business you're looking to build is one of the bigger businesses rather than the medium-sized businesses, you might look to your network and see if you know any within your family and friends, whether anyone there is able to invest. The UK offers very generous tax incentives for early stage businesses. You get 30% back as a UK taxpayer up to a limit if you invest in companies, and then if they end up failing, you get a further 30% back. And those percentages are even higher for even earlier stage businesses. And so, it's for people that understand the ecosystem. If you're looking to raise a bit of money, it should be relatively straightforward comparatively to other countries to find someone and to say, hey, you can put in cash in the business and you get income, you get cash back by the taxman, which is a great win-win. You get money and the person gets money back. And so there's a large industry to support you. So you find the different types of investors. It might be these VCs, it might be some of these tax funds, it might be family, it might be friends, it might be angel investors. You might find them online. Generally, there's been a movement and a shift towards much more open conversations, a much higher cold outreach metrics, i.e. because of the lack of diversity currently in the VC space across both funds and angel investors, who are individuals that invest in startups, there's been a trend towards being more open in taking cold inbounds and taking applications. So if you find a VC that you like and you go on their website, maybe 1 out of 3 will have an application form for you to fill out, which means you don't need a warm introduction. And VCs are quite happy now shouting about the great brand they've built in order to generate these cold emails. And so if you're starting off, I wouldn't be too concerned, especially for some of the angel networks that are very open with outreach. So you've got your materials, you figured out what kind of company you want to build, you identify investors, you start outreaching to them, and you start having conversations, first, second, third meetings. You manage to persuade some to invest in your business. You might then want to hire a lawyer, or if you're a very early company, you might use a platform like Seed Legals, which provide lots of functionality for you to be able to close your round. And you can choose the terms, you can choose the terms of the market, and then you can pull all these investors to invest in your company through that platform. And that's kind of it. You can jump in, jump out at each different stage, but ultimately you're trying to you're effectively you're a salesperson when you're fundraising. You are, instead of selling the product, you're simply selling shares in your company. And so the art of selling, being prepared, identifying relevant potential buyers or investors, and then actually negotiating to get them involved is pretty much the way that the process works.
And how would someone go about setting the valuation of their company when they're out? Is it a supply and demand piece where that valuation might change depending on how much interest you've got, or is it based on the founder and the experience of the people and the team? What factors would someone account for when you're thinking about the valuation when it's just at that pre-seed kind of idea type stage?
I think that the idea stage and the pre-seed stage, if you're considering valuation, is there's lots of complicated and scientific ways of thinking about it. But as many people know, valuation is more of an art than a science, and often you can spend hours diving into lots of different methodologies. But the most common way of thinking about it is simply that you often get diluted between 10 to 20% per round. And so you're offering 10 to 20% up of the business, and you're therefore the range of valuation is already approximated by the equity that you're willing to give. And the other side of the equation to get a valuation is, of course, the raise amount. And that is often a function of how much money do you need to get to the next stage. So if you plan that you need $500,000 or $1 million to build the product and to generate a bit of traction, then you'll be raising $500,000 to $1 million. And if you're raising $1 million and you're giving away a fifth of the business, then that sets your valuation the 5 or 6 mark broadly. If you're raising $500,000, same thing, you're setting your valuation 2 to 3 mark. And so the best way of thinking about valuation is simply how much you're looking to raise, and your range is how much you're expected to give. And if you're an angel, you'd invest slightly less and receive slightly less stake. And if you're a VC, a venture capital fund, you might take 15, 20, 25%.
And what is an angel for people that aren't familiar with the terminology?
Sure. So an angel often is an individual investor who might want to invest some of their salary or savings into early stage companies because they might see the return, so they might want to benefit from a big exit and be one of the early investors, or B, they might simply have exited and built a business themselves, and therefore they might want to invest in companies they know and understand. So within the fintech space, one of the most active angel investors is Monzo's ex-CEO, who's now invested, I think, one of the largest number of companies in the last couple of years. And he's built his career at Monzo, and he's decided now to start angel investing, i.e. invest his own money into those companies.
And can you talk through again in terms of like terminology in fundraising? when we say kind of pre-seed, seed, Series A, Series B, Series C, and so on, what do all those things mean?
Sure, and they all mean different things to different people, and the quantum is constantly changing. However, the basics remains the same, that pre-seed are companies and founders who are yet to develop a product, they've got an idea, and they're yet to build the technology or build the product. They're pre-seed. Seed is typically when you've got your product or your app or your whatever you're building, but you're yet to properly commercialize it. So you haven't generated lots of traction yet on the product. And then your Series A is when you've got the product, you've got some form of fit with the market because you're starting to generate customers, and you're looking to raise in order to do more of the same. You've got your product, you've got the market, and you've got some customers, and you put money in, and then money comes out. And then as you grow the alphabet, it starts being much more about metrics. So Series B, for example, you've got the product, it grows, you've got customers, you're doing well. Can you nail down these KPIs to make sure that you're growing in the most efficient way, with the best team around you? And so it starts being about the metrics than the actual business. But that's generally the way that it goes. You're finding the product, you've got the product, you're finding customers, you've got customers, and then you're really kind of scaling up those customers.
So let's talk about your journey, because you've gone through this yourself, right? You've started up your own company,
Yeah.
and you've had to, I suppose, dog food your own advice that you've been giving over the many years. How did you, what did you think about when you had the idea that you wanted to go out on your own and do this? And how did you approach risk and return? Because it's all about risk and return when you're looking at these type of things. What was your thinking process? And did you have a long-term goal, or did it organically just fall into this and evolve into starting up your own venture funding business?
So in terms of the business, if I was going to think back about the documents and the business profile of the business I was looking to build, it's very much a medium-sized business. So it's not a lifestyle business. We're looking to grow year by year, and we have done in the last 3 years. It's not going to be a unicorn Uber type business because it's very heavy on the people side, and it's practically impossible to build a scalable business with people rather than technology. So it's a kind of in the middle bucket of a medium size, relatively good growth company. And as a result, we decided therefore not to take venture capital funding because we weren't going to appeal to the investor that looks to invest in us. Although we've had a lot of interest and appetite from investors especially following some of the acquisitions in the space, who want to invest, but we don't need the money, and we don't have any desire to be controlled or have any consents from someone else at the moment. And so that's what we decided. We didn't need venture capital funding. We might have needed and might use loans as an example if we're looking to expand, but generally we're looking to grow in a much more sustainable way. And that's the business we decided to go into. In terms of how we went about doing it, although I've started my first business at university and I've always wanted to build something of my own. The way that it happened is kind of quite a natural occurrence. There was less thinking, more as long as you're proactive, curious, and get involved in different things, opportunities normally come to you. That's what I found. That's what we advise when a company joins an accelerator. I'm sure you've done lots of accelerators. The more you put in, the more you get out, and that's generally what seems to have occurred throughout my career. You're curious, you get involved as much as possible, and then opportunities come to you. So when I joined the innovation team and started some of these programs, it was, I think, probably as a result of meeting some people at probably a tech startup, drinks of some kind, following up, going to more of those kind of events, because that's what I was interested in, and that morphed into forming that team. And so I think the advice I'd give from a fundraising perspective and a career journey is the more curious you are, and the more of a yes person you can be, the more likely you are to then find the area of interest. And for me, leaving PwC after just under 10 years of being there seemed like a weird thing to do, because at the time I think I could have seen myself staying there for the long term. But it was a factor of a number of different aspects. We built a successful business within the firm. We were getting much more pressure from various different stakeholders to who wanted to get involved. A lot more politics in a big firm. Everyone wants to own you if you're successful, and the compliance was getting up too heavy. So it sometimes took us a couple of months to actually engage and work with companies, as opposed to now the 24 hours it takes us to work with someone. We're still regulated, so we've still got a lot of compliance in KYC to do, but we can move much more quickly. And then regarding taking the leap and leaving a fairly well paid, fairly cushioned job, I'm not sure why and how, and not sure why we did it at that time, or how we went about doing it. I guess I had 6 months of savings.
Was this around COVID as well?
It was just before COVID. Just fun. I think we decided 5 months before COVID, and handed my notice in 2 months before COVID, and we'd saved 6 months, and so I guess we had 6 months to make it a success, and fortunately we did, despite the world falling apart in March.
Indeed. One thing that I learned when we did the PwC Raise program was, and I hadn't probably thought about it as much, but if you could talk through, when you talk about VCs have to go out and raise money, right? And they're raising money from high net worth individuals, other companies, pension funds, the government, other banks. Or can you talk through the makeup of that? Because that wasn't something I fully appreciated until I think you kind of lifted up the rock and you could see what was under there.
Yeah, that's always my favourite workshop actually to give, and I'm glad it I guess made an impact in understanding how they think, because I think that's the most important aspect of fundraising and selling. I think if we talk about selling in general, because that's what fundraising is, understanding the buyer is probably one of the most important things to consider when you're in the market. And a poor salesman or salesperson is one who doesn't understand the buyer, and I think everyone can relate to being sold something they don't need or they don't want. And the same is applied to fundraising. If you can understand the type of investor or lender you're speaking to, how they operate, it makes you in a much stronger position to actually sell what they want. And within the spectrum of funding options, there's a multitude number of different types of investors. The tax efficient investors I mentioned before, where they had the tax break, they don't work at all like the VC funds because they need much lower return profiles. The angel investors don't work at all like the VCs because it's their own capital. They're investing their own money into these companies, and therefore the process, what process? There isn't a well-defined institutional rigor in their assessment. They might meet you, they like you, and here's the money with a bit of diligence and a bit of legal homework. But the VCs in the traditional sense, which is the kind of sexy industry in London and what a lot of London is known for, is built upon a concept of managing someone else's money. And so VCs, although they appear, scary, or they might appear like they've got all the power, they're just middlemen. They have no power at all. They're simply taking someone else's capital and putting it to use. Very different to the family offices and very different to some of the corporates. And so understanding that the person that you're pitching to isn't there to invest their own money, they're there to invest someone else's money, leads you down this kind of avenue of realizing why you need to produce this set of documents, realizing why you need to produce a 5-year model, realizing why you need a business plan. It's not because they need one, it's because they need to cover their back if you end up failing, because they need to say, oh, I met Matthew, he was a great business, and here are all the things he told me. And therefore, I don't want to lose my job because I did all the right things and I diligence, and it's called the duty to your investors or your limited partners, who are the name given to these investors. And that's how the industry operates. And so once you understand that, you understand that, you empathise more with someone asking you for these documents. Instead of saying, oh, why do I need to give all this stuff? Why do I need to waste my time? You start thinking, okay, they're simply there to persuade someone else to make the decision. And as soon as you have that mentality, you start realising that your job as an entrepreneur is to make their lives as easy as possible. And that's why documentation, preparation, all these things are vitally important, because it's not about you selling them, it's about them selling you internally, and the conversations carries on. So that's one large, aspect that is fundamental to the fundraising process, is understanding who you're dealing with, and understanding that you're not dealing with an individual, you're dealing with an organisation. The second angle, which I imagine you were also referring to, is the understanding that they are also in the same position, i.e. they are also fundraising from limited partners. And what we like to tell founders is how fortunate they are compared to their funds. Because a typical startup fundraise might be 3 to 9 months. A typical VC fundraise will be 2 to 3 years. Not only that, the population of investors as you go up the food chain shrinks. So you can imagine like a pyramid, at the very bottom, the entrepreneurs, you can access everyone above you. You can access the governments, the funds, the family offices, the corporates, all these individuals that are there to support the ecosystem. And as you go up and up and up, you have fewer and fewer options to raise from. And so if your population as a founder is 100%, your population as a VC is maybe 10%. And why is it 10%? Well, it's because VCs are there to being built to invest in entrepreneurs, whereas family offices and if you were investing in funds out of your own personal wealth, you weren't built to invest in funds. You weren't built to invest in anything. You're there to probably build a business and to do your day job. And so VCs are pitching to a much smaller pool of individuals. And so as a result, they've got the exact same fundraising process that you do.
And how does the life cycle of a fund work? Because you said it might take 2 or 3 years to raise money, and it'd be anything from a few £1 million for a very small fund up to billions for big funds. How does what are the VCs then judged on by their investors for that fund? Does it have a cut-off time? You hear this term, kind of dry powder and lots of money to deploy. Can you talk through that?
Yeah, I mean the VCs, much like the entrepreneurs, have the exact same issue to deal with, except the population of investors is smaller. And so everything we talk about, the preparation, the profile, understanding how they think, how a family office thinks is very different to how a government thinks. Government's taxpayer money. The biggest owner of startups in Europe are us, the taxpayer, because we pay taxes. Even if you don't have a business, you pay VAT or whatever. In Europe, you pay taxes. The government takes those taxes. It then spends it on things. Some of those things include funds into a pot of money. That pot of money goes into funds, and those funds go into startups. And so if I'm pitching the government, I'm pitching a very different proposition as if I'm pitching an individual. And so the exact same process applies. It's just the difficulty is 3 to 5 times as hard. And in terms of the life cycle, they have an investment period of 3 years. They raise for a couple of years. They invest for over 2 to 3 years. They then look to divest and look to manage their portfolio through helping exits, maybe IPOs, maybe trade sales. And so the when you speak to them within that process is critically important, because if you're speaking to them at the end of the deployment process, you might be 1 in 1,000 companies they invest in, as opposed to 1 in 100 companies. And so the later on in the process you're speaking to, the more difficult it is to actually receive funding. And then you've got the added complexity of multiple funds within the same entity across different years. And in terms of process to raise the next one, the first fund is easy, well, easy-ish in the sense that everything's relative. It's bloody hard work to raise, but it's easier than the next few. So the first one is kind of relatively easy. The second one is relatively easy because you've got the relationships already from the first. The third one is practically impossible because by the time that you're raising your third one, 7 or 8 years in, if you haven't had any big exits, then there's nothing for you to hide behind. Whereas in the first one, you can say, we are going to be great. In the second one, you can say, we have been great, because you can see all these high valuations. The third one, you have to actually show cash returns, which are difficult to find.
Yeah. So this is a work in fintech podcast. So can we touch briefly on fintech? The UK is a global leader, has been for a long time, but I think the crown is beginning to slip, if not has slipped already. But can you talk about why fintech is so established in the UK? And we've seen some big funding rounds for fintechs in the UK, all the way up to the top where you have like your Revoluts and your Monzos. Can you talk through the kind of the ecosystem and the environment and what funding looks like and the kind of magnitude and quantum of what we're seeing here in the UK?
Yes, think about it. Why are we such a good, fintech nation? Probably because London is, I think, a lot of the developed world, but London in particular is strong in professional services, i.e. people on people rather than just tech. And as a result of the professional service industry, that goes towards where the money is. And the money generally is within financial services. And so you end up with a strong professional services within the financial services industry. That then leads to, breed of new entrepreneurs who are leaving the big banks and building better startups and better technology, knowing all the problems and the pain points. And so you have a big industry with lots of issues that, still, great relatively. You then have all these people that are coming out of those organizations wanting to make things better, and that's how a lot of the challenger banks were born. And then within that section, you then have all these various different spin out when the successful companies exit or when people leave. And so you have this fantastic increase of talent from as organizations grow and as organizations exit, much like you have in America with the likes of some of the early Microsofts and Amazon and various different mafias. In the US has a lot of mafia, the eBay mafia, which I think there's some charts in the US that if you look at I think a couple of companies and you draw these diagrams of where people have gone, I think 2 or 3 companies represent over a third of some of the unicorns in terms of ex-employees or what have you. And that's what kind of happens with the FS sector in London. So that's one of the reasons. I think the second reason is the regulatory burden that is, the regulators are some of the best in Europe, and therefore UK seem to be setting the bar, and that applies across lots of different industries. And then the reason why it might be different now is obviously because of Brexit and the passporting issues and and all these other issues that might have made it less likely for it to continue its long-standing lead. But I suspect that it's not going to close overnight, and London is going to continue being a world leader within that space. In terms of numbers and deal volume, it certainly represents the largest sector in the last decade. In the last couple of years, there's been a lot of fads. The Web 3.0 fads, the crypto fads, the AR VR fads, and now the OpenAI fad, and all of these sectors are kind of popping up. Post-COVID, of course, you had healthcare. So you've got these various sectors that are coming along, but over the last decade, fintech's definitely been the most significant investment area for companies. And if you're building a fintech, the number of fintech within B2B investors is probably the biggest pool at any given time. and so you'll certainly have a large population of hungry investors.
So to wrap up, in terms of people who are kind of listening to this and might be thinking of, having an idea for a business, and you've explained, kind of in detail some of the steps and the processes and so on. In terms of some of the skills that people, kind of soft skills that people can work on in the meantime, like you've spoken about when you were working on the data side, and audit back in PwC when you very first started, and you appreciated that actually audit is going to get automated. So having the thought process and the foresight to kind of think further forward and how it's going to impact what you're doing today. And then you spoke about how curiosity is super important, and passion and curiosity for learning and increasing the surface area of your network, the people that you meet, the ideas that you have, the things that you read, is all going to, incrementally build up your knowledge and your network and the people that you know. Is there any other kind of good words of advice to kind of young people in general who are just starting a career, and things related to kind of funding and business ideas?
I think not having a grand plan is certainly a good one, because the world moves so quickly that having a well-trodden path is an unlikely optimal strategy. I think being open, embracing what's around you, and constantly learning and evolving is a much better path to take. And I think curiosity and drive can provide sufficient risk minimization to make your your career successful. I'm in the very fortunate position that I don't really work for a living. I just I do what I enjoy, and so I'm happy to when we speak to clients, happy to speak to them at any time of day, be it evenings, weekends, because for me it's not work, it's just another fun pastime. And if you can be in that privileged position, that explains, I think, the reason why a lot of the most successful entrepreneurs are successful, because they can work round the clock, because they don't see it as work. That's how, and I think that's why a lot of companies and a lot of people find it difficult to split work-life balance. That's ultimately because they're not enjoying the work bit, and it's not for everyone. But if you're going to be building a company, it takes a lot of time and effort. And so if I was thinking about one single piece of advice, it would be do something that you enjoy doing. And especially when you're young, try and experience lots of different things for you to figure out what it is you enjoy doing. And that's what I did at PwC. I worked in at least 5 different teams, and specifically, as soon as I started, within the first year, first thing I did was make friends with all the resource allocation staff, so that I could be on as many different things as possible, rather than simply, a lot of my friends ended up working on one company for 3 years, and I couldn't think of anything worse than joining a company which provides you experience of working with different companies with only doing one thing. And so the follow your passion, following where you want to work, can only happen if you allow yourself to be involved and experience different work streams, because otherwise you don't know what you enjoy. And then regarding the future, I think it's clear where things are going. Technology is going to be ever increasing, and so if you were going to think about a way of a sector or something that is that you're interested in, if it uses technology and there's an aspect of relationship in there, then it's likely that you're going to succeed, because relationships, human to human relationships, aren't going anywhere, and technology isn't going anywhere. So if you can combine the two, you're en route for success.
So Jonathan, how can people get in contact with you or learn about some of the resources that you've mentioned?
Sure. Sure. So we're, I was always happy to respond to any emails, as long as it's not a automated email. I'm on johnford@mountsideVentures.com. You can drop me a note, or you can look at our website. And I mentioned at the start that our mission was to optimize the fundraising process for founders and for funds. And unfortunately, given that we're still a people-based business, we can't work with everyone. We only work with a very small number of companies we speak to every month. So in order to cater for that, we publish a lot of information on our website in order to give others the tools and the know-how and the investor lists to do it themselves. So even though we might not support them formally, hopefully they're going to be in a better position to actually access those tools. And so you can find pitch deck templates, you can find our latest term sheet report, which analysed terms from 200 different funds. We publish them, analyse them, summarise them. So if you're raising and you look at our term sheet report, you can go, oh, actually, this term isn't market. You could have used it for your raise, actually. This term isn't market, this term is. Can I negotiate based on what I've seen? So you can find all those resources on our website.
Fantastic. Jonathan, thank you for your time.
Pleasure.